Are you feeling overwhelmed by annuities? Well, you're not alone. Comparing charts, the fine print, and endless sales pitches can leave anyone feeling confused. But here's the good news. We're here to make it simple. And in this video, we'll uncover the secrets behind those complicated illustrations, break down the fine print in plain English, and show you how to compare annuities without spending countless weeks and months shopping around.
Yes, stay tuned to the end where we'll reveal a secret that most annuity salespeople and websites don't want you to know and will not share with you. Hi, I'm Kai.
And I'm Ann. And here's Gracie, after coming home from the groomers looking like a toddler with pigtails.
Annuities can be tricky to understand, especially when you're staring at pages filled with numbers, guarantees, fees, and terms that you've never seen before. These fine print details can leave you scratching your head as if you're missing something important. It could seriously impact your financial security down the road as well.
When you're not familiar with the terminology, it's easy to feel overwhelmed and just sign on the dotted line. But here's the truth. That's exactly what insurance companies and financial institutions are counting on, that they want you to feel intimidated by the fine print. But we're here to tell you that it's not that complicated, and with the right guidance, you can crack the code on annuity fine print.
Now, assuming you've already decided which of the 5 income riders are best for you, then you will follow these next 3 steps in comparing illustrations. First, understand the terminology, not just what it means, but how it can work for or against you.
Second, know where to find the fine print in the illustrations and how that impacts you. And we'll show you a few sample illustrations so you can feel confident when you're meeting with us.
And third, uncover the 5 secrets annuity agents don't want you to know.
Yeah, stick around because this is going to be fun. Now, before we dive into the fine print, let me remind you, like Kai had mentioned, make sure to check out our Step 1 playlist. That playlist covers the 5 types of annuities and explains key terminologies you'll need to know.
Now, here's the thing. Understanding the fine print won't matter if you can't clearly define the differences between such terminologies such as SPIA, DIA, MIGA, FIA, VA, RILA, or even a hybrid pension. Now, if those terms sound like alphabet soup to you, then the Step 1 playlist will give you clarity and help figure out which type of annuity is best for your needs.
Right. Think of it this way. You can fully understand all the details about a sedan, but if what you really need is an SUV, you've made the wrong choice from the start. Well, the same logic applies to annuities. Whether you watch our first playlist before or after this video, understanding the 5 types of annuities and 5 income riders is essential to fully grasp any illustration.
So now let's shift gears and focus on the terminologies related to the fine print inside the illustration. We're going to break it down step by step, looking at the pros and cons of each term, and most importantly, how they directly affect you. Now, let's get started.
Okay, let's address the elephant in the room. Liquidity. Everyone seems to worry about accessing their money, and this is the #1 scare tactic financial advisors use to steer people away from annuities.
And you might have even heard from, say, well-meaning friends, don't buy an annuity. You'll lock up your money or pay huge surrender charges.
Yeah.
Well, here's the truth. Surrender charges by themselves are not a reason to run away. Some advisors make it sound like you'll be stuck with your decision for the rest of your life, but that's not true. That's not accurate at all. So how can you understand the pros and cons of this fine print then?
Well, if you look at the first few pages of an annuity illustration, you'll see the surrender charges and withdrawal limits outlined clearly. Now, you won't see these pages with SPIAs or DIAs, including QLACs. And why is that? Well, because these types of annuities don't have surrender penalties. And here's why. With SPIAs and DIAs, you've annuitized your contract, and that means you forfeited your principal, given up control, and have no cash value growth. You also can't change your mind later because you've essentially surrendered your cash to the insurance company.
As one of our other videos mentioned, annuitized, just remember the letter Z is the last letter of the alphabet. That means it'll be the last time you ever see your cash value. It's gone. This is critical to understand so that you can protect yourself from these misleading sales pitches. For example, selecting a SPIA or DIA simply because an agent says they have no surrender fees is like someone telling you buy this special water because it has no sugar. Well, that's ridiculous. Everyone knows water doesn't contain sugar.
Right.
So the same logic applies here. SPIAs and DIAs inherently don't have surrender fees because you've already surrendered your cash value.
But deferred annuities are different. Now, these are including MYGAs, FIAs, VAs, and hybrid pensions. And with these, you don't lock up your money for life. They do have surrender charges, but those charges typically only last for a few years. And again, you can find this information in the first few pages of the annuity illustration. Now, Kai, wouldn't you agree that surrender charges are often misunderstood and exaggerated?
Yes, absolutely right. There are so many sleazy marketing gimmicks out there, from financial advisors to online websites, YouTubers, podcasts, all trying to scare people away from annuities by overhyping the surrender charges.
Yeah, but here's the contradiction. Those same advisors will not tell you to run away from CDs, bonds, 401ks, IRAs, mutual funds, real estate like REITs, or 1031 exchanges, HSAs, or other investments, all of which also have surrender penalties or restrictions.
And chances are you already own one or multitude of these type of investments and understand the limitations in early withdrawal penalties. Yet you still felt they were a smart investment because they served a specific purpose. The same is true for annuities. As long as you've chosen the right annuity for your goals, surrender charges should not be your main concern.
For example, if you purchased a hybrid pension to secure contractually guaranteed income for life, the surrender charge becomes really a minor issue because you're not planning to access that lump sum anyway. So now let's break down how these surrender charges actually work in more detail.
First off, here's something many people don't realize. Annuities are often more liquid than a CD or other investments. With most deferred annuities, you can typically withdraw 5% to 10% of your funds each year without any penalty.
And why is this important? Well, one of the biggest concerns people have about annuities is the fear of locking up their money forever. You want to feel confident that your money is accessible, whether for emergencies or simply because you don't like the idea of any insurance company telling you what you can and can't do with your own funds.
You know what's interesting when I mentioned liquidity, you think about how many people are willing to buy rental properties.
Yeah.
You can't take out 5 to 10% of you've locked up your money.
Right.
It's completely locked up. So again, the contradiction. Now, let's talk about this withdrawal privilege. What happens if you take out more than the 5 or 10% penalty-free withdrawal? Well, here's the good news. You're only penalized on the portion above the penalty-free amount.
Yes.
So can you give an example, Ann?
Yeah, an example would be, let's say you deposit $500,000 into an annuity, and the penalty for early withdrawals is 10% in the first year. Now, if you withdraw $60,000, the first $50,000 or 10% is penalty-free. The remaining $10,000 would incur a 10% penalty, which is just $1,000.
To put it in perspective, many people have lost far more than $1,000 in a single day in the stock market. So why don't advisors tell you to avoid investments since you can lose 10%, 20%, or even 50% of their value on a market downturn? Well, the answer is simple: management fees.
When it comes to annuities, the surrender charges are part of the mechanism that allows insurance companies to offer you higher interest rates, better caps or participation rates, and lifetime payout rates. So think about it. Without these controls, how could they guarantee those benefits if everyone could pull their money out whenever they wanted?
Exactly. And you want more good news? Surrender charge schedules usually decline over just a few years. Some carriers reduce these charges aggressively by about 1% per year. Depending on the type of annuity, they might also give you the interest earned on a point-to-point basis, or even offer a daily accumulation value, or DAV, which credits interest up to the day you surrender the contract.
And here's another perspective. Many people are willing to take out a mortgage loan with prepayment penalties. Why? Because a mortgage rate is a great deal, and they understand that the penalty allows the bank to offer such favorable terms. The same concept applies to annuities. Surrender charges make it possible for insurers to provide those higher rates or guaranteed benefits.
And here's the final point. Surrender charges also play a role in financial stability. They prevent situations like the collapse of the Silicon Valley Bank, where too many investors were able to just pull all their money out at once, creating a liquidity crisis. These controls ensure the long-term stability of the annuities benefits for everyone.
Kai, have you heard advisors or internet gurus telling people to avoid annuities because of the high fees or the spreads?
Okay, you hit a hot button. Well, let's clear this up. First, not all annuities have fees or spreads. The ones with the most notable fees, ranging say from 2% to 4% that you've probably read or seen, are variable annuities called VAs, or another one is registered indexed linked annuities called RILAs. You can see the full list of potential fees from these on your screen right now.
But here's the thing. Many annuities, like MYGAs and FIAs, can come with no fees or spreads at all. And this means the narrative of high fees is often exaggerated or misrepresented. We hear it all the time. I want an annuity with no fees or commissions. I hate fees. And that's understandable. Many people are concerned about commissions or hidden costs.
Okay, now that's another hot button. Well, let's break it down. SPIAs, single premium immediate annuities, and DIAs, deferred income annuities, also includes QLACs, qualified long-term annuity contracts, or longevity, have no fees. Why? Because with these, you're giving up your principal. No fees, but your money is locked up for life. So while there's technically no fees, the cost is giving up your principal.
Now, MYGAs, multi-year guaranteed annuities, have no fees either. FIAs, fixed indexed annuities in general, will have no fees or spreads, but they might give optional fees for higher potential returns through higher participation or higher cap rates.
And what about commissions? Well, you never pay us, and our commissions will never come out of your principal. The insurance company pays us directly. Insurance agents like us have no management fees because there's simply nothing to manage. It's like your Social Security. It's like the money through pensions, or it's like a CD. There's just nothing to manage. So there's no fees.
Right. And we get paid directly from the insurance companies, just like your car and home insurance agents get a commission from the insurance company.
And I'm sure you've seen how so many websites and advisors exaggerate the fees just to scare people off. Yeah. As a matter of fact, we made a video I would like you guys to look at if you haven't done so. It's where we called out Dave Ramsey for his misleading statements specifically on annuity fees and commissions.
Now, Kai, if many fixed index annuities have no fees or spreads, why do some illustrations now show them?
Well, fees or spreads typically appear only if you choose an optional higher participation rate or higher cap rate. So it's an option. These aren't mandatory. Again, they're simply tools offered for you as a choice to potentially increase your earnings. Think of it like paying points on a mortgage to secure a lower interest rate. It's your choice. It's completely optional and is tailored to your financial goals. And just a reminder, a participation rate is a percentage of the index gains you participate in when you're watching the index. A cap rate is a maximum gain you can earn. Now, we had another video, and again, just watch our playlist where we go into the participation and cap rates more in detail.
Now, if there's a fee or spread, it'll be listed alongside the index options on your illustration. Some carriers even let you change your fee or spread option at each renewal, giving you flexibility.
Now, a spread, by the way, isn't like stock trading, where you just take the spread either before or afterward. It's always technically a fee. A spread, when it comes to an annuity, only applies to new gains per point to point. Like icing on a cake. If there's no gain or there's no icing, then there's no spread. So if there's no icing, there's nothing to take. Does that make sense? And let's address another common concern. One frequent objection to purchasing annuities, particularly fixed index annuities or FIAs, is the rider fees. Would you address that?
Sure. So we get that a lot. But riders are optional. They're tools for specific goals like legacy planning or guaranteed income planning.
Well, I guess we can think of it like an umbrella policy for your base home insurance policy. It's not a scam. It's a choice that you make for a peace of mind.
Correct. And the two most common riders are your death benefit riders, for those concerned about leaving something behind, and your living benefit riders, or as we like to call them, pension riders, for guaranteed lifetime income. Now, you can only choose one per policy. Either you're protecting against dying too soon or living too long. And it's crucial to understand these riders, as they can either be a waste of money or a financial lifesaver.
And what's our client's favorite rider?
The living benefit rider.
Yeah, who wants to talk about death?
No one.
Right. So this living benefit rider is a powerful feature which transforms a normal fixed index annuity into what we call a hybrid pension. It provides contractual guaranteed income for life, all while maintaining control of your funds, and it continues to grow as well throughout the years you're taking income or deferring. Now, where do you find these riders on the illustration? Well, look for the word rider on the first few pages. And if you're unsure, ask the agent. If they're hesitant or they dodge that question, that raise a red flag,
Oh, yeah.
maybe just run away.
Run away. Now, why don't all carriers call it a pension rider or a living benefit rider? Well, because that would make things too simple, right? Instead, you'll see terms like income protector, high point income base, guaranteed living withdrawal benefit, and more. So how do you know if your illustration is a hybrid pension? Well, look for keywords like income, withdrawal, or lifetime combined with the word benefit.
Now, for hybrid pension illustrations, you'll notice additional columns in the illustration beyond the usual. Let's take a look at these illustrations here. You got your usual cash value column, surrender value, and death benefit value. That's pretty much on almost every illustration. To either the left or the right of the illustration, you have a few more columns, and this will represent the living benefit value. And this represents the formula for your pension value. So what you're going to see is the living benefit column, then you're going to have a payout factor, which is a multiplier applied to the living benefit to calculate your lifetime income. Then you have your guaranteed income withdrawal amount, and this is the amount of the contractual guaranteed income that you'll receive. Now, be careful. Some illustrations are hypothetical and not guaranteed, and we'll discuss this later in the video. Then the last column is your total cumulative withdrawals, a running total of all the income you've withdrawn. So we'll cover this in depth in the next section on indexes and performances, so stay tuned.
Kai, fixed indexed annuities, or FIAs, have gained a lot of popularity recently, especially with the higher participation rates. So what are agents not telling people about these new FIAs?
Well, the new FIAs offer many indexes to choose from, including the typical S&P 500 index. However, the S&P 500 index often has lower caps and participation rates, so many agents won't emphasize it or even show it. Instead, they focus on other indexes with participation rates that are often double or triple that of the S&P 500.
So is that a marketing gimmick, as some advisors and websites suggest then?
Yes, for the bad companies and also the bad agents out there, where they're using it as a bait and switch tactic. But the good companies that price these products correctly are not playing these games. Insurance companies are typically prioritizing risk management and predictability when pricing caps and participation rates. Now, let's break down the three factors they consider. Number one is volatility. Insurance companies aim to reduce the risk while trading options. If you were managing risk, would you prefer a high volatility index or a low volatility index if you were completely retired? Obviously a lower one. So lower volatility indexes are more predictable, making them less risky for the insurance company. And because of this, it allows predictability, therefore giving higher caps and higher participation rates. High volatility indexes like the S&P 500, because it's so volatile, have low caps and low participation rates. And it's just too much risk for the insurance company.
Yeah, but please note, if you see an S&P 500 option with a high cap or participation rate, it's likely a low volatility version of the S&P 500 and not the standard indexed.
Now, if you see a high cap or high participation with a standard S&P, you're going to generally find out that there's no lifetime income rider for that particular FIA, or the income rider has a very low contractual lifetime payout.
The second factor is the cost to trade the options tied to these indexes. Popular indexes like the S&P 500 have higher trading costs, resulting in lower caps or participation rates. Less popular indexes are cheaper for insurance companies to trade, allowing for a higher caps and participation rates.
Now, to manage future costs, many insurance companies use older or newer indexes that may be less, say, well-known. Now, why? Well, most investors are not specifically looking for low volatility indexes. Many tend to seek bigger swings in the market to capture the higher returns.
However, insurance companies operate differently. Their primary revenue source is through insurance policies and not investments. By choosing low volatility indexes, they can better manage risk and stabilize caps and participation rates, avoiding drastic drops over time.
Now, some companies create what's called proprietary indexes that are not publicly traded. Only the institutions or partners involved in developing the indexes can actually trade its options.
And how does that benefit the consumer? Well, proprietary indexes reduce volatility and cost by limiting unpredictable external swings. This allows companies to offer higher caps and participation rates for longer periods.
Now, a word of caution. Be careful of carrier-created annuities and indexes that prioritize profits for the CEO over the consumer's benefit.
Non-carrier created indexes designed by independent engineers and researchers are typically more consumer focused as their success depends on clients choosing their models. Now, Kai, some advisors claim these new indexes are so new that clients can't know their performance. What's your response to that?
Well, how does anyone predict the future performance of any index? They look at the past. Index funds, as we know, track a specific market segment and consist of real stocks and assets. Even for a newly created index, you can backcast its performance by analyzing how the index stocks or assets performed over, say, the last 10 or 12 years. So insurance companies are also heavily regulated by state agencies. So any backcasted data must meet strict standards for accuracy.
Now, Kai, what returns should we expect in these types of fixed index annuities with these newer or low volatility indexes?
High volatility indexes typically average around 8% to 10% or more returns. So if you see a high participation rate, say 150% to 300%, it's likely tied to a low volatility index. This allows for potentially enhanced returns while maintaining stability and predictability, like we mentioned, which are crucial for both not just the client, but also the insurance company. Here are a couple examples of low volatility indexes with the participation rate applied. And we'll use a lower return of, say, 4%. So if you have a 4% index return with 150 to 200% participation, it will yield around 6% to 8% average returns. Again, let's take a 4% index return with 200 to 300% participation. It should yield around 8% to 12% average returns.
So it's not just about participation rates.
Exactly. You need to evaluate three crucial factors: the participation rate, the volatility of the index, because that's what you capture, maybe higher gains, any fees or spreads tied to the index, because again, that can eat up the gains as well. So good companies will illustrate the overall performance clearly, and proactive agents will use the software to analyze the best performing indexes for you. Unfortunately, we find out that many agents are either too lazy or they just don't know how to do it. But this is the core part of our all-set process, which all of our agents must follow.
And final note for skeptics, for those who wonder how insurance companies can offer over 100% participation rates, watch our detailed video where we reacted to Dave Ramsey's video. And here's a hint, you're not investing or buying shares of the index. So watch the video and we'll explain it all there.
And by the way, in that video, we also talked about how the insurance companies are only using give or take 5% of their total assets to buy these options of the index. Majority of their investment portfolio are basically 70% to 80% bonds, 10% to 15% mortgage loans. So again, they're not really putting all their money into the index either. Usually typically around 5% or so.
Good point. Kai, many have asked us, can an insurance company just change the participation rate or cap anytime?
Well, yes and no. No company can change it during your point-to-point renewal. The bad ones might bait you with a high cap or high participation, but soon after your first or second point-to-point, they'll just drop it drastically. The good ones, on the other hand, are not trying to bait you and upset you. They want to build a solid reputation and earn repeated business. These companies follow the three key principles we discussed earlier: predicting low volatility, finding low-cost options to trade, and eliminating external influences that can cause these unpredictable swings.
Yes, and building a solid annuity with these principles takes time, but these companies are known for their good reputation among consumers and agents alike.
And what have you noticed as to why agents or advisors explain the participation rates incorrectly or exaggerate that the insurance companies can just change them at any time?
Well, we've seen that many financial advisors or insurance agents don't specialize in annuities, or they just want to make a quick sale. Almost every client who calls us has either shopped with another agent or come back to us after comparing. And I would say 99 to 100% of them never have this level of explanation. It simply takes too much time to understand and then explain all the details. And unfortunately, there are more ineffective or unethical agents and advisors than there are trustworthy ones. Many of these individuals partner with companies that prioritize short-term gains over the long-term well-being of their clients.
Yes, and because of the lack of transparency, agents will often fail to provide clear guidance on how to identify reputable professionals or organizations that genuinely prioritize the interests of consumers. It's like someone saying to stay away from stocks without showing you how to find the good ones. So to recap, To truly understand annuity illustrations, it's crucial to grasp the key terminologies and know where to locate them on the illustration, the fine print. But the last point is perhaps the most important, the unspoken read between the lines, the fine print.
Now, are you referring to the 5 secrets that many annuity agents won't disclose?
Yes. But before we dive into the 5 secrets, we hope you can see that we put a lot of heart and thought into these videos to provide full transparency and disclosures. Each video actually takes us an average about 80 to 100 hours to create. So we want you to understand that there are good and bad companies and agents out there. It just takes a lot of time to shop and compare. That's why we've created our all-set process to eliminate the frustration of learning and spending so many hours comparing annuities and advisors.
And if you've enjoyed this video so far, please help us out by showing YouTube's algorithm that this video is worth watching. You know the drill. Please click the like button, share this video, and subscribe if you haven't done so already. And as a thank you, here's a picture of goofy Gracie playing hard to get before taking a bath.
Now, by the way, has this video helped you better understand the fine prints and the annuity illustrations? Please let us know in the comments below. Okay, now let's get into the number 1 secret. Not being transparent with your cash value.
So what's the number 1 secret that annuity agents typically won't show or discuss? It's about your cash value. Now, there are 2 main pages, the minimum guaranteed page and the past performance page.
Now, why won't agents show you the minimum guarantee page? Usually it's because they don't know how to explain it. Here's an example. Do you see how this carrier is showing you a 0% gain every year on the first column? Well, this page might look like it's the worst case scenario. As a matter of fact, financial advisors love to emphasize this page as a huge disadvantage. Many annuity agents avoid showing this page because they think too that it's the worst case scenario.
But doesn't minimum guaranteed mean the worst case scenario?
No. Minimum guaranteed means the minimum they'll give you is 0%. Remember, if the market falls, you won't lose anything, but you won't earn anything either. So this page shows if the market crashes every single year for 30 years, no recovery, no uptick, just crash, 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 then you will earn 0%. So think about it. A market that crashes every year for 30 years, if I was to show that to you, say the S&P was crashing for 30 years every single year, no uptick, no recovery, would you say that's the worst case scenario?
No, I mean, that would be an impossible scenario.
That's right. All you need to know is that you won't lose your money, and the minimum the insurance company will guarantee you is 0%. So it's impossible for the market to crash every year for 30 years.
Now, how about the guaranteed income rider or the living benefit value?
Now, that is the worst case scenario. If you earn 0% in your cash value and you had this impossible scenario, the market crashing every year, then that would be your contractual minimum guaranteed income.
Yes, this page is extremely important, especially if you're being pitched a hypothetical income rider. Many annuity agents promote these riders because they seem promising, but they often hide the minimum guaranteed page or rush through it. And this is because they want you to focus on the hypotheticals, which can look appealing, while the other guarantees are often quite low.
And some companies even place this page at the very end of the illustration to avoid drawing attention to it.
And this is the page you need to focus on to know your contractual lifetime guarantee. If the market doesn't do well, and if the insurance company messes with the participation rate or caps, this page tells you exactly what you're guaranteed.
Good point. Now, if your illustration doesn't show guaranteed lifetime or benefit value, living benefit rider, then your annuity will not provide you lifetime income as a rider. You won't have any guaranteed income at all unless you annuitize your money or turn it into a SPIA or a DIA, as we discussed earlier. Now let's discuss the page that most agents will show you and how to accurately interpret this page, the past performance page. This page typically shows you 30 years out again, but then you'll look at the fine print. It often shows you the past 10 years repeated or the past 12 years repeated.
And what's the big deal with that?
Well, history doesn't repeat itself right away 3 times. Whether it's the good annuities or the bad ones or the good stocks or the bad stocks, it just doesn't happen. Plus, we don't know what the participation rate will be 20, 30 years from now. So I'm not saying it's wrong to use this page as an indication for the next 10 years or so. The good companies, insurance companies, have already bought their bonds, as we mentioned, and they've already sold their mortgage loans. And that's really, again, about 90% of their investment portfolio. So the first 10 to 15 years is going to be pretty solid. It's not a huge deal to look at. It's the 20 to 30 years is where I personally get more skeptical.
Now, if you're not purchasing a lifetime income rider or living benefit rider, focus primarily on the next 10 to 15 years. Most likely, you won't keep the annuity past that point and will eventually replace it with a better one.
However, if legacy planning is important to you and you're concerned about 20 to 30 years from now, consider adding a death benefit rider. This guarantees a minimum interest rate regardless of the index performance, cap, or participation rate.
However, if you bought a lifetime guaranteed rider or living benefit rider and are still concerned about legacy or your surrender value, then you'll want to look at the long-term projections of 20 to 30 years from now.
And again, our video on the 5 different income riders will compare the lifetime contractual income and how your cash grows. So don't forget to check out that video. So again, there's nothing wrong with looking that far out, but don't let the annuity agent convince you that there's a good chance that your annuity will grow that much 20 to 30 years down the road.
Now, Kai, what's the number 2 secret that not only annuity agents hide, but the insurance companies don't make clear?
Well, they fail to disclose that your income rider is not your cash value, or they don't clearly mention that huge bonus and roll-up does not apply to your cash value. That's the misleading part.
Now, we covered this marketing gimmick in more detail in our 4th playlist. Many clients get upset later because they didn't fully understand this. Now, curious, have any of you or anyone you know gotten scammed into thinking their bonus and roll-up was how their cash value was going to grow? We would love to hear your story in the comments below.
And remember, we made a video and I talked about the guy I played tennis with.
Yes.
He thought that money was going into his cash value as well. The third secret that many agents won't disclose is that they're trying to sell you the hypothetical, not the contractually guaranteed income rider.
Yes, those can be misleading. We made a video explaining the 5 types of income riders and why you need to be cautious with hypothetical riders. And as we mentioned, the illustration may look impressive, especially when based on the past 10 years of performance and then repeated for the next 30 years.
Now, make sure you look for the guaranteed minimum page to see the contractual lifetime guaranteed income. If you have to ask for this page or ask to have it explained, then that's a red flag, and again, maybe run away from that agent or advisor.
The contractual guaranteed income riders, which we call flat and level, will show exactly the same payouts on both the guaranteed minimum income page and the past performance page. Now, on the other hand, hypothetical riders will have a drastic difference, with the minimum income being not attractive at all.
Yes, you'll see that. Now make sure to watch our in-depth video like we talked about earlier that explain the 5 types, not of annuities, but the 5 types of income riders. You can find this video in our first playlist titled, What's the Best Annuity? 5 Income Riders Explained. The thumbnail says, Annuities Too Good to Be True. So look for that video. And in that, we'll also discuss the next secret, the 4th secret. And?
Well, the 4th secret annuity agents won't show you is the patented DAV model. DAV stands for daily accumulation value. And this model still uses the typical point-to-point strategy, but also gives you a daily accumulation value, allowing you to capture higher gains rather than being stuck with the point-to-point limits. They also compare the highest DAV with the minimum guaranteed income rider and use the greater of the two to calculate your income.
This model also gives you the potential for increasing income once you've started drawing from it or started the lifetime income. This model is also discussed in that video that we talked about, the What's the Best Annuity, the 5 Income Riders Explained.
Now, why don't agents go into this model? Well, often it's because they only represent one or just a few companies, and they don't fully understand it themselves. And that's why we specialize in annuities and represent over 50 different plans. We know these options inside and out.
And even if you have an agency that does represent many carriers, you'll come to find out they just are really pushing just the few carriers that they want to sell. Now, the 5th secret that annuity agents and websites hide is regarding their online income calculators. Annuity agents love to use these online income calculators, but there are 2 big issues with them. They can be outdated if the web developer isn't notified of the rate changes, and these can change monthly, if not sooner. They don't give you the full story.
It's like getting a price list for a computer and only seeing the price and model without knowing the exact processor, memory storage, or graphics card. Would that be enough to compare? No, of course not.
And that's why we manually compile a comparison sheet for our clients after they've gone through our all-set process. This includes 7 key components: the contractual minimum guaranteed income, whether it has a nursing home or ADL doubler, the financial ratings of all the rating firms, the Comdex score, which is the average of all ratings an insurer has received and translated into a score of 1 to 100, the caps and participation rates, the fees and spread options, and the lifetime income rider charge.
And this page takes us almost an hour to compile per person because we run current rates for your state and age. Most agents won't take the time to do this, but we do because we want you to see through the all-set process just how hard it is to get a thorough, unbiased comparison.
Now, we know that there are bad annuities and bad agents out there, but why should the good ones suffer along with the bad? Our goal is to cut through all the propaganda you hear from financial advisors, annuity agents, websites by providing you with the knowledge that you need through our 4 playlists. So, in review, to fully understand annuity illustrations, learn the terminologies, watch our 4 playlist, and know where to find the important pages on the illustrations.
And most importantly, test your agent or advisor to make sure they disclose everything transparently. They should be upfront with this information, not leaving you to uncover the secrets on your own.
We hope we've helped you to see annuities are not as complicated as it appears. You just need someone to give you unbiased guidance.
So let us know in the comments below if this video has helped.
Also, here are the 4 playlists we encourage you to watch. Feel free to share this video and the playlist with others.
And we're committed to making your journey in buying an annuity clear, stress-free, and with confidence.
Have fun.